Coming up, the lessons of the financial crisis.
It's not just about finance, but I think we can make finance more robust in the sense of more capable of coping with the sorts of shocks we've experienced and we're going to experience again.
Financial Times commentator Martin Wolf discusses the shock of the Great Recession and how to move forward. It's just ahead on Global Ethics Forum.
It is a pleasure to welcome Martin Wolf back to this podium. He will be discussing his book, The Shifts and the Shocks, What We've Learned and Have Still to Learn from the Financial Crisis. His rigorous thinking, deep insights, and incisive comments will stimulate you today, just as they did when he first spoke here a few years ago.
So let me start off with a point which the introduction allows me to make fairly potently. This was a colossal failure. It was a colossal failure of policy, and it was a colossal failure of the financial system. I don't think we can discuss why it happened, and I do, but we have to start with a recognition of how colossal the failure was. And there are three dimensions of this at least. First, with a very few exceptions, and there are a few, nobody foresaw a crisis on this scale and magnitude. There were lots of people who expected very serious trouble, lots of people who thought that the pre-crisis trends couldn't continue. I was one of them, but I didn't envisage the complete meltdown of the financial sector, but that we would come to the point at which essentially the core financial system of the Western world would cease to function as a system, which is where we were, which is very clearly much worse than what happened in the 30s to the financial sector. The core financial system, the money center system in the 30s continued to function. Most of the banks that failed, and there were a huge number of failures, were relatively small banks. The big banks that did fail, and there were one or two, were essentially in continental Europe, particularly the famous Creditanstalt story. So that was a much bigger economic disaster, but the financial disaster this time, the implosion of the system, was extraordinary. So the first thing is that wasn't expected. The second point was just the scale of this disaster. And the third point was the economic long-run consequences of this have been absolutely enormous. And I'll give you one indication of this, that is in terms of the US economy, which is that if you take the trend growth of the US economy from 1950 to 2007. It actually fits quite well. There are some periods in the 60s you're a bit above that trend, and of course the 70s and early 80s below it, but it's a reasonable fit, and you just extrapolate that forward to 2014, and you ask yourself, well, where does the US economy in the second quarter of 2014 compare to that long-term trend? And the answer to that is the US economy is now 18% smaller. 18% smaller than what that trend would imply, and than pretty well every forecaster expected. By the way, for the UK, it's the same. For the eurozone, it's also much the same. These are losses in present value terms of many, many times GDP. Unless we get an extraordinary resurrection in growth. And by the way, there is literally no crisis-hit country in this case that has got back to the pre-crisis trend rate of growth, let alone the level implied. And I'm not even talking here about the effects on labor markets, on incomes, which you are familiar with. So it is a devastating crisis. And as I point out very clearly, that the core policymakers, as I've already indicated, didn't expect or understand this. On the contrary, the very possibility of a Great Depression type scenario in the financial sector didn't appear in any of the conventional economic policymakers' frame of reference or in the economists who were advising them. Even the most skeptical of this, probably the people who came closest among the academics were Carmen Reinhardt and Ken Rogoff in their book, This Time is Different. I wonder whether, obviously they don't foresee this, whether they expected such a total meltdown. So that forces us to confront the question, well, why were we so wrong? Analytically, why did we rule out this very possibility, and what drove this? So in addressing that question, this is the second thing, I tried to look at this in the way, perhaps largely in the way of the one economist who I think basically got this sort of story right, who had been largely ignored, and that economist was Hyman Minsky, who had been largely ignored by conventional economics because he didn't believe that the market economy was fundamentally stable. On the contrary, he believed it tended to generate its own instability. And the most penetrating notion he has is a wonderful, very simple sentence: stability destabilizes. So far from a great moderation indicating that everything is going to go on forever in a very moderate way. When everybody thinks there's a great moderation, you should really be terrified. Because we as human beings, and particularly we as human beings operating through financial markets, will create risk in this situation. And there's a very simple way, which is again central to his analysis, of how we create risk in this situation. If you are in a world which is seen as moderate, stable, and so forth, then you will want to take on risks. And there are two different ways of taking on risk in the economy. Really productive ways, like starting new businesses, being a true entrepreneur, and you'll get some of that, and it's why a lot of booms go with innovation, okay? And the other way, it's the good old-fashioned way, which he discusses, is leverage. You know, you just leverage yourself up in that sort of world, and we leveraged ourselves up in the years up to the crisis in terms of ourselves as households. That was quite a new thing. It wasn't mostly non-financial corporates, so they played some role. It was overwhelmingly households. And in terms of the financial sector itself, the balance sheets of the financial sector in scale, which of course is largely a counterpart of what was going on in the rest of the economy, and the complexity of the financial sector, but also the leverage within it. So to give you a very simple idea, the major banks of the world roughly doubled their leverage in the 4 or 5 years running up to the crisis. They varied in the individuals, but it became quite normal for the major banks of the Western world to be operating with leverage in the 40 to 50 to 1 range, which to all intents and purposes meant that they didn't have any capital at all. Their capacity to bear losses was almost zero. As I said, stability destabilizes. But again, following Minsky talked about something that triggered a displacement event, a trigger that started off this process. And in my book, I argue that a crucial trigger, not the only one, but a crucial trigger was something that happened in the late 90s and early 2000s, which was a collapse in global real interest rates on safe assets. Basically, the global real interest rate on safe assets, which can be measured, the IMF has talked about it and I discuss it, halved in the late 90s, roughly speaking, from around 3.5% to 4% to 2%. That's a very, very big shift. And it coincided with, and in my view was not at all just a coincidence, with the Asian financial crisis, which I have regarded in my previous book as an incredibly important event which most people don't understand the implications of. And essentially this did two things. First of all, the Asian financial crisis persuaded the most dynamic economies in the world with the best investment opportunities in the world that they were not going to borrow capital net from the rest of the world again. They weren't going to run current account deficits, and if you were China, you were definitely going to run very large surpluses, and you were going to insure yourselves against financial risk by running your policy in such a way that you could accumulate enormous claims on the rest of the world, above all the US, into the form of foreign currency reserves, which simply exploded upwards from the Asian financial crisis. So the time of the Asian financial crisis, gross foreign currency reserves, all this increase was in the emerging country, were about $1 trillion, and today they're 12 trillion. And when they hit the crisis, they were close to 8 trillion. So the emerging world became a capital exporter in this and other ways, a lot of it. And the biggest chunk of this was China, but it wasn't just China. Everybody got into this game. So the people with the best opportunities became capital exporters. This created the global savings glut, which was associated with the global imbalances. And there were two other things creating a global savings glut, in my view. I analysed these at less detail because they were changing, but they were very important. One, changes in income distribution in our societies in the direction of greater inequality. And second, a fascinating puzzle which people have not written about enough, which started about the early 2000s, which was a situation in which the non-financial corporate sector of the Western world started, its profits rose dramatically and its investment did not. So the non-financial corporate sector of the Western world, and I include Japan, became a net supplier of funds to the rest of the economy. Quite consistently, it was investing less than its retained earnings. That's other important component of the global savings glut. So if you think about it, the emerging world is supplier of funds to the rest of the world economy. The non-financial corporate sector was the same. Rich people who were doing very well were certainly not wanting to borrow. What did this leave us with? Well, it left us with essentially only two classes of potential borrowers, households and governments. And we've been oscillating between the two ever since. We either have huge government deficits or we have huge household deficits. Since we want to get rid of our government deficits, we are for sure going to try and recreate another household leverage cycle. That's definitely what we're going to want to do if we're going to develop demand. This is the macro story, and into that is imposed, and the macro story is very important. I don't think this can be just understood as a purely financial sector story. We have this very fragile financial sector of ours, which had more capacity to create leverage quickly, swiftly, and powerfully than ever before. A lot of the innovations in our financial sector, the creation of derivatives, which construct leverage within them in many, many different ways. The shadow banking sector, as has already been mentioned, was an essentially unregulated banking type structure, so we're able to generate leverage within it to extraordinary degree. And the leverage in a money market fund is literally infinite. There's no equity at all, which is fine if the assets are absolutely safe, as they're supposed to be, but it turned out they weren't. What people thought was safe turned out not to be safe, and the buck was broken, and then suddenly the money market fund business doesn't look as... So that was another part of the run that you got here. So leverage was created in innumerable ways. Then financial innovation, the originate and distribute model, which generated, in addition to all the leverage, fantastic non-transparency. So people didn't know what they were owning. One of the most remarkable achievements, I've made this point many times, of America was that it was able to take a large amount of very, very bad housing loans and distribute half of them across the world. So I thought it was really rather clever. It's one of the things that may not be known, but it's a funny puzzle, that the British banking sector, which is very, very large, lost substantially more on American mortgages than it did on British mortgages in this crisis. Bad, non-transparent lending, leverage, and finally, global financial system. So when things really went wrong, they went wrong globally because everybody was so interconnected. And there are so many dimensions of this. But one of the dimensions, of course, it turned out, the Fed realized this very quickly, is that so many of the financial institutions that were playing such a big role in the American markets were foreign. That forced the Fed then had to provide dollar funding to these institutions by generating a whole slew of swap lines with other central banks. So the Fed very rapidly found itself the lender of last resort, not just to the American banking system narrowly defined, but to the entire global financial system because it affected dollar markets. It's just one aspect of it. Finally, let me say, I regard the eurozone crisis as reflecting all that stuff, with Germany emerging as the surplus country in that context, but, well, the Northern Europe emerging as the surplus. It was banning, there was a savings glut within the eurozone, of course, the global one. This was offset by another mad housing bubble, the biggest and most important of which was in Spain, which became, was running current account deficits of 10% of GDP, and the housing boom much bigger relative to its economy than America. In this world in which everybody was convinced again that there was no risk, all spreads on all government bonds in Europe disappeared, so that all these spreads collapsed. Lending was seen to be absolutely safe until it wasn't, and then we had waves of panic. starting really, first of all, obviously in 2008, then in late 2009 with Greece, then building up because of the impossibility within the framework they'd created for the eurozone, which lacked nearly all the institutions to cope with a first-class financial crisis, so they had to invent it, and none of the institutions for coping with making the adjustments work to the failure, to the changes in competitiveness that had occurred within the eurozone. A whole wave of crises which culminated with in the summer of 2012 with the decision of the European Central Bank to offer its so-called outright monetary transactions program, never yet used, might still be used. In fact, I think it's rather likely, and I don't think it will work. So finally, let me talk briefly about the lessons of all this. The first point is what you might call the global economic balance side of this story. We have a fundamental problem, which is that the countries with all the opportunities in the world don't want to borrow capital from our financial markets because they think that if they do, they're going to blow up, and they're probably right. They want us basically to absorb the products of the financial sector internally. And that creates a very fundamental macroeconomic problem for the world as a whole. And this is the bit of my book which I think is the most original. Everybody thinks the financial sector failed. That's obvious. I've got lots of ideas about what should be done about it. But I'm arguing that I can't see any stable and sustainable way for the developed countries as they are now run to absorb the surplus savings of the world without periodic crises. The least bad approach, in my view, is to absorb them in public sector investment in our countries. It's the least likely, however. The political resistance to this is sensational, even though interest rates, both nominal and real, are extraordinarily low. What we, in practice, tried to do, apart from the point in the immediate post-crisis period when we did accept the fiscal deficits, what we're trying to do is to get these surplus savings absorbed in our private sector. The non-financial corporate sector is consistently surplus. It's not going to borrow this money in aggregate. I mean, the most interesting indication of this, your most competitive, most profitable companies, Apple, Google, do they need money from the markets? No, they are huge investment funds. I mean, Apple is an immensely gigantic investment fund, a colossal one, growing all the time, which has as a sideline a very profitable tech company. And so if you compare this with the 40, 50, 100 years ago, the US Steels, the GMs of those times, they don't need the money. And they're not going to borrow it, and neither is GM or any of these other companies going to go out and build really large-scale plant. They're very profitable. They're going to continue to put money in the market, not take it out. I think that's an ongoing structural condition. It's been true in Japan for 25 years. We're going to have to create household borrowing. And somewhere we're going to have to create household borrowing, or we're in permanent quasi-depression. This is the secular stagnation argument. And Europe is worse because the demography is much worse. So once you took the housing bubbles out of the European equation, demand just stopped. And I mean this quite literally. This is very important to understand. Most people don't focus on this. In the second quarter of 2014, real domestic demand in the eurozone as a whole, an economy roughly the size of the US, was 5% less than the first quarter of 2008, 5% less. Yours is roughly 6 or 7% more. So you've had some growth in demand. They've had a collapse. And in the last 3 years, it has shown essentially no growth at all. That's depression. That's just bang, slump. So we have a tremendous aggregate demand problem. And unfortunately, this is very problematic in Europe because Germany believes that it is conceptually impossible to have an aggregate demand problem. And therefore, they can't do anything to address it because it can't exist. We have this fundamental demand problem. In the long run, the way to fix this, without a doubt, is to get back to lending from us who are naturally saving surplus countries. Our major institutions are saving surplus. Most of the people who earn income are saving surplus. If we don't want to run huge fiscal deficits, we have to lend money, provide capital to the emerging world net. And to do that, we have to provide them with insurance that will encourage them to take the capital, and that means a complete reconsideration of what the IMF is for, and to go back to what Keynes thought it should be for. Of course, I know this isn't going to happen. I'm just following it logically. Keynes, of course, on this fundamental matter was right. The American position at Bretton Woods was wrong. Fortunately, you got your way. Inevitably, you got your way because you were the most powerful country, and I think by now you should have regretted it. There are some Pyrrhic victories, and Harry White's was a Pyrrhic victory. Of course, the assumption was the US would be the creditor nation forever, but I'll leave that, and it would never have the problems it now has. So that's the first big thing. The second big thing is the financial sector. The financial sector, broadly speaking, and deleveraging our economies. I think it's difficult to do much of this in the macro context I've described. It's why I think the macro context is so important. It's not just about finance. But I think we can make finance more robust in the sense of more capable of coping with the sorts of shocks we've experienced and we're going to experience again. And I would stress two elements of this just for now. The first element is that it would be a very good idea, and Atif Mian and Amir Sufi discussed this very well in their excellent book, House of Debt, and others, Ken Rogoff and others have talked about that. If we encouraged a move away in our financial contracts, which means also in our tax system, away from our extraordinary reliance, extreme reliance on the inherently inflexible and crisis-prone structure of debt contracts, and move more to what might call risk-sharing or equity-sharing type contracts. So this is particularly important if we're going to rely so heavily on household borrowing, particularly house price-backed borrowing, collateralized by housing, because it's very difficult for a household to grow out of its debt in the way a corporation could do. So it's far better to have structures which sort of basically say that if there's a generalized shock of some kind, the lenders share the risks with the borrowers. And there are very easy ways to do that. You could imagine, for example, that instead of having a straight mortgage type loan, the principal of a mortgage will be indexed to the general index of house prices. So it wouldn't be, so you wouldn't benefit from not investing in your own house, but if the whole house prices in your country or in America, perhaps a state or a city, were to fall by 20%, mortgage loans will go down. There's risk sharing in the system. Of course, that would require tax changes, but that would get us away from the mass bankruptcy problem that we otherwise face as soon as we get a crisis of this kind. So deleveraging the economy is one thing. And the other thing, of course, is we need a less leveraged banking and financial sector. I think we've made small moves in this direction. I'm strongly sympathize with those people who think we should have much more capital in banking and financial institutions, particularly any banking institutions that we regard as systemic. So I sort of believe that we should think that leverage in such core financial institutions shouldn't exceed 10-1. I also discuss the Chicago plan, 100% reserve banking, but I don't think I'm going to have time to discuss this. I'm very tempted by this, though I have to admit there are all sorts of problems. But I'm basically assuming, in other words, that we're going to continue to have problems in need to lend to households if the governments aren't prepared to borrow in a large way, or even to adopt helicopter money, which I discussed, Milton Friedman's proposal. If the government is not going to go that way, then we're going to have a financial sector which is much more capable of bearing stress than it was before the crisis, and households whose borrowing characteristics in terms of the contracts are much more flexible and allow much more automatic restructuring of the debt than we have been able to do this time. And we've had this tremendous debt overhang problem which remains with us to this day. So let me conclude then by saying, one, a huge disaster. Two, rooted in serious intellectual misunderstandings of the way the economy interacts with finance. Three, It had a macroeconomic triggers, which are really, really important to understand, interacting with a deregulated, innovative, technology-driven finance sector, which proved incredibly fragile. The eurozone was all that, plus the incredible rigidity of its institutional structure. We need to think very, very seriously about the nature of the demand that will be generated in the economy to use our potential productive capacity. What we are doing is moving from one bubble to the next, and I discuss in my book, I won't go into this now, the China's bubble, which was a reaction to the failure of our bubble to generate demand in China once they lost the export markets, and we're going to live with the consequences of that. This is a real problem, and we have to think very, very carefully about how we can create a financial sector and debt structures, or if you like, intermediation structures in our economy that are less disaster prone than the one we have now created. Today, unfortunately, we still have an incredibly highly leveraged economy in the Western world. There's been a modest deleveraging, but to give you one indication, gross debt, private debt in the US relative to GDP is only back to 2003 levels. So you've got 4 years before it blows up again, as it were. If we repeat the last experience, I'm not saying you will, but it's remarkable how little deleveraging there has been. In Europe, there's been no deleveraging at all in aggregate in the private sector, never mind the public sector, which has been leveraging like mad. The financial sector we have is more concentrated before, certainly more regulated with incredibly intrusive capital, but it remains incredibly highly leveraged and fragile. So in conclusion, it's a disaster, but we still have a great deal more to learn. Thank you very much.
For more on this program and other Carnegie Ethics Studio productions, visit carnegiecouncil.org. There you can find video highlights, transcripts, audio recordings, and other multimedia resources on global ethics. This program is made possible by the Carnegie Ethics Studio and viewers like you.